There's a 24-year-old in San Francisco running a $13.7 billion hedge fund. He's a former OpenAI researcher, and when his first big portfolio filing dropped, the entire market stopped to read it. But here's what's a little bit strange. At the same time he's making a massive bet on the AI build-out, he's also put on a massive short against some of the biggest companies that are leading the AI revolution. Today, I'm going to walk you through the whole portfolio, line by line, and actually go into the one detail that 90% of the coverage got wrong. So with that being said, let's get into it. So first of all, why does anyone even care about what this fund actually does? The hedge fund manager's name is Leopold Aschenbrennera. I hope I said that right. He was on the OpenAI's super alignment team, and he left in 2024 and wrote a viral essay called Situational Awareness. He basically argued that superhuman AI is coming this decade, and the build out will be the investment story of our lifetime. A very, very sexy investment thesis. Then he did the thing that most people don't do. He actually put his money into where the essay was. He raised a fund. Anchor investors included the Collison brothers behind Stripe, Nat Friedman, and Daniel Gross. And the early returns were absurd. It was up 47% in the first half of 2025 versus 6% for the S&P 500. So when this fund files, people pay attention. And they don't just pay attention, they literally copy it. The entire portfolio runs on a single sentence. It buys the bottlenecks of the AI build-out: power, compute, and memory. When I talked about Jensen Huang's AI infrastructure tech stack. And it also shorts what AI actually eats. It's a very, very logical, intuitive investment thesis. Underneath it is an aggressive call. AGI lands by 2027. Super intelligence by 2028 to 2030. His belief that the market hasn't priced the sheer industrial scale that requires of AI, the power plants, the data centers, and supply chains. You don't have to believe his timeline, but you should understand how he built a trade around it. Here's the shape of the whole book. It's what the pros called a barbell. On one side, it's high conviction longs on the physical infrastructure. On the other side is big puts to hedge on the chip stocks. Think about how most people own AI. They buy the broad theme, the obvious middle. He deliberately cuts out the middle. He longs what AI needs, and he shorts what AI eats. There's nothing neutral in between. Okay, this is the most important slide in the video, so stay with me on this one, okay? Every headline is screaming $8.5 billion short against NVIDIA. That number is misleading for 3 reasons. 1, it's notional. It's not cash at risk, right? 13F reports, if you look into it deeply, it just shows the value of the underlying shares, the options control. It doesn't show the premium that was actually paid. The real money at risk on those puts is a fraction of 8.5 billion. Massive, I believe it was a credit default swap during the pandemic where he made I think it was over $1 billion from just $30 million, right? The reason why he was able to make that asymmetric return was that it was derivatives, right? It was a very complex financial product where the total value of the product, if it actually exercises and has a value, is much higher than what you actually pay. Okay. 2, you only see one side. 13F, it hides the short stock, the swaps, and the cash. So the net exposure, the number that actually matters, is invisible to us. And 3, it's already 45 days old the moment we see it. So this is the March 31st snapshot. He could have disclosed the whole thing, so just keep that in mind, okay? All right, so let's look at what he's actually short, okay? He's $8.46 billion in put notional, okay? It's spread across 11 chip names, with the big idea being that he wants to hedge a part of the AI stack that's absorbed the most hype. So let's really break down what this short book is saying. Number 1, the biggest position is an ETF. It's a basket against the whole chip complex, so it's pretty broad. 2, this is a very sharp one to keep in mind, right? Oracle is the only software or cloud name he shorts. There's no Microsoft, no Amazon, no Google, no Meta. He's going after one hyperscaler, funding its AI build out with debt, and he's sparing the ones with the fortress balance sheet. That's a precise view, not a blanket AI is doomed bet. 3, it reads more like insurance paired with his long book. The whole thing kind of behaves as a way as crash protection against the most crowded layers. So he's not necessarily bearish on these companies in his short book, in my opinion. Not financial advice, he's just hedging the part of the AI stack he believes is the most overvalued, overexposed. Alright, now is the fun part. This is where his conviction actually lies, in his longs. Okay, and his longs are lined up really in 4 different areas. Lined up in power, compute, miners, and memory. So let's take them out one by one. His number one long right now is Bloom Energy. It's about $934 million of the fund, and it's up over 176% from where he bought it. The thesis is beautiful in its simplicity. The thesis is pretty beautiful in simplicity. There's a multi-year waiting list to connect a big data center to the grid. Bloom makes on-site fuel cells, which you generate your own power and skip the line. Electrons are the real ceiling on AI, and he's betting on the company that removes that ceiling. He backs it with T1 energy and a natural gas through EQ2. Bottleneck 2, compute. This is CoreWeave, about $700 million in total value. It's a GPU cloud neocloud. It buys NVIDIA chips at scale and then rents it out. Pure exposure to AI demand without betting on which chip wins. And here's the irony you should say out loud. He's shorting the chip makers while going long the company whose entire business is buying their chips. That contradiction in the thesis, short the valuation, long the demand, is what most people are really getting confused about. The third bottleneck is arguably the most interesting part of his portfolio. It's looking at the Bitcoin miners that are pivoting into AI infrastructure. The Iron, Core Scientific, Applied Digital. These are companies that the market still prices as crypto lottery tickets, but they're quickly pivoting to AI infrastructure. And he looks at these companies and he sees something that most people don't see. He sees power contracts, land, and grid interconnects. That's the exact stuff that's impossible to get right now. Let's look at Iron. It's up 493% in a year, with a deal with NVIDIA worth $2.1 billion for 5 gigawatts of capacity. Wall Street consensus is a buy near $78. The real asset was never Bitcoin. It was the megawatts, the energy. Memory. This is the one you guys might be familiar with. SanDisk. SanDisk is Leopold's highest multiple winner so far. It's supposedly up triple digits already, with around 1.1 billion combined with options. And the catch here is kind of nuanced. He's long the memory shortage through SanDisk and Micron calls while shorting Micron stock. Bullish the shortage, bearish the multiple, but the same company, both directions. So how did we get here? Last quarter, his book looked like a clean AI infrastructure long book. This quarter, he kept all those longs and layered $7.7 billion of fresh chip puts on top. He added to Bloom, CoreWeave, SanDisk. He trimmed NVIDIA, Vistra, and Broadcom. He flipped Intel from calls to puts, but net he was still a $1.9 billion buyer of the stock. The barbell was born this quarter. The big question is this guy a genius, or is he just calling the top? The hedge camp, which is the popular view in this case, says it's insurance. He's still net long AI. Yeah, the rotation camp says chips are priced for perfection, so sell the designers and rotate into the physical layer. Now, before you go ahead and just copy Leopold's entire portfolio, keep in mind that this is not the most recent 13F that Leopold has filed, right? This is just the 13F that I've gotten the chance to do deep analysis on and present to you. Since this 13F, Leopold has had a few adjustments to his portfolio, including adding Nebius, which is now one of the largest positions in his portfolio. But this core theme of longing certain parts of the AI tech stack and also shorting other parts of the AI tech stack is something that is still present in his portfolio today. Now, what I would recommend is to not just copy this portfolio name for name. Really study which individual companies you find real conviction in and build your thesis around there. So here's what you can really take away from all this. It's a barbell. It's not a bet against AI. Also, the conviction is in power, compute, and memory. And 3, notional headlines, what you see on Twitter or Instagram, it doesn't really show you what really going into the 13 in depth can show you. This is the clearest map of what I have gotten from one of the smartest people in AI so far and how he's positioning this next AI boom. Whether he's right, we'll find out in his next filing. We'll find out in the actual returns 1 year from now, 3 years from now. So if this breakdown helped you, please feel free to subscribe. I'm going to be doing a breakdown of these filings every single quarter. That way you don't have to. So put in the comments down below. Are you hedging? Are you longing the longs? Or are you selling out everything?